My name is Adam Posick. In today's session, we're going to talk about different options for designing your profit sharing allocation. Before we get into the details, though, let's take a quick review. For starters, when we're designing the profit sharing allocation, we want to take into account the needs and objectives of our client or of the company. It's really easy to fall back into the habit of using what worked for the last 3 or 4 clients without considering what a new client might need or want to accomplish. So you can see some of the things that we want to think about. Does the client want to maximize the benefit to the owners? Are they looking at the profit sharing plan as a tool to recruit or retain employees? Are they looking to provide broad-based benefits or to focus benefits on a select group of individuals? Do they want it to be really easy, or are they okay with a more complicated design? The actual might be some combination of these. It might be all of them. It might be none of them. We also want to keep in mind the various limits that apply to the compensation and the contributions that are available when we're doing the design. Today we're primarily going to be focused on this limit right here, the annual additions limit in a defined contribution plan. That's the maximum amount that any one individual can get for the year from all different contribution sources. Also, when we're designing the plan, and we have to think about non-discrimination testing and the limits that the IRS places on how much can go to some of these important people that you see on the screen. So, for example, the concern is that we want to make sure the plan doesn't discriminate in favor of either highly compensated employees, who are generally your owners or those making more than $120,000 a year, or your key employees, which again are going to be your owners and your officers and those making $150,000, $170,000 and above. All right, with that as background, let's go ahead and take a look at the different allocation methods that are available for divvying up the profit sharing contribution among the eligible employees. We've got 2 broad categories of allocation methods. One is the design-based safe harbor category. And here we have allocation methods that, as long as we're giving contributions to enough people, regardless of the level of benefit we're providing to each person, these are going to be considered to satisfy the non-discrimination requirements by definition. So there's no additional testing that has to be done. And we're going to go through each one of these in the rest of the lesson here. The second category are those that are the general tested allocation methods. Here we have the age-weighted and the new comparability method. These methods require additional non-discrimination testing to verify that they're not disproportionately favoring highly compensated employees. So they do add a little bit more complexity and usually a little bit more cost when it comes to the operation of the plan. So here it's important again to think about whether a particular plan sponsor is okay with the added complexity or the added cost. But as we'll see, oftentimes the benefits that are derived from these methods are enough to make those additional complications and costs worthwhile. We won't spend much time on the age-weighted method because really the new comparability method will allow you to do everything that the age-weighted method does, but it also offers a lot more flexibility. So we'll skip over age-weighted and spend our time talking about new comparability. The per capita method is really straightforward, and it does exactly what you would guess from the name. And it basically provides a uniform dollar amount to each person in the plan who's eligible to receive a contribution. So let's take a quick look at an example. So you can see right down the line in this column right here, everyone is receiving the same dollar amount of contribution, the $21,250. And that certainly results in a lower percentage of pay for the highly compensated employees than it does for the various non-highly compensated employees. Now you'll notice here that we haven't been able to maximize the owners at the $53,000. And the reason is because there's an additional limit we didn't talk about before, and that's the tax deduction limit. And that basically says that a company is not allowed to contribute and deduct anything more than 25% of the combined compensation of all of the eligible employees. So basically, in this example, it's the $850,000. 25% of that is the $212,500 that we see right here. So that's the maximum that can go into the plan and still be deductible to the company. So as a result, if we're trying to give everybody the same dollar amount, we're stuck with the $21,250 rather than being able to get the owners up to the $53,000 each. The next method is the pro rata method. And in this situation, rather than everyone receiving a uniform dollar amount, everybody receives a uniform percentage of pay. And when we're looking at this and when we're talking about it, we can express it a couple of different ways. One, if we know the percentage that we're targeting, we can say, for example, everybody's going to get a 5% of pay allocation. Easy for all the participants to understand, but it doesn't readily translate into a solid budget number. So some companies, rather than say we want to give everybody 5% of pay, they're going to say we want to make an annual contribution of, as in this example, $100,000. And then we go through and we have to figure out how much of that $100,000 gets allocated to each person. And you can see the formula is pretty straightforward. You take the participant's compensation divided by the total compensation of all eligible participants in the plan, multiply that by our total contribution of $100,000, and that's going to equal that individual participant's allocation. And here we have the familiar chart that we saw from the last example, but rather than the per capita method, we're illustrating the pro rata method. You can see right up here at the top, our two owners have $53,000 each. That is a 20% of pay contribution for the two of them. And because the hallmark of this allocation method is that everyone receives the same percentage of pay, you can see right down the line all of the rest of the participants are also receiving a contribution equal to 20% of their compensation, for a total contribution amount for the company of $170,000. That's below that 25% deduction limit that we talked about a couple of slides ago. So the company can contribute this entire $170,000 and deduct the entire amount, maximizing the two owners at $53,000 each. Our next allocation method is the permitted disparity method, and this is also referred to as Social Security integration. And basically what this does is it takes into account that Social Security benefits are only provided on compensation up to the Social Security wage base. For 2016, that amount is $118,000 or $118,500, and it is indexed for inflation. So that number does go up, usually every year, although we have had a couple of years where it's remained constant. So basically what this method does is, by acknowledging that Social Security benefits are only available on the first $118,500, is it allows a slightly larger contribution in the profit sharing plan on any compensation that exceeds that level. And it's an attempt to sort of equalize the benefits for folks that are making more than that amount. So here's a quick chart to sort of illustrate how it works. So we take an individual, and let's just say that this person makes $265,000 a year, which again is the maximum pay that we can consider. So their base compensation is actually that entire amount, the entire $265,000. We have the Social Security wage base of $118,500, so anything that this person earns in excess of that is going to be called excess compensation. So in this case, it's $146,500. And the way that the permitted disparity method works is that the plan can provide an additional contribution, an additional percentage of pay on the excess compensation, and that amount, that excess, is usually capped at 5.7% of that excess compensation amount. So that's added to the base contribution, which is going to be the same percentage for everybody, and that's how we arrive at the total allocation for a particular individual. So let's take a look at all of the numbers and see how they shake out, and again, hopefully this will make a little more sense. Again, we're targeting $53,000, which is the maximum for the two owners. It's our same total allocation of 20% of pay, but you can see that it's broken down a little bit differently. So we know from what we talked about on the last slide that each of these two individuals have total comp of $265,000. That means they have excess comp of $146,500 each, right here. So really what we're going to do is we're going to back into the allocation. We know that the maximum we can give on excess comp is 5.7%. So if we take 5.7% of $146,500, we get $8,350. Then it becomes simple math from that point. We're taking the $8,350, deducting that from the $53,000, and we know that we have to fund an additional $44,650 in order to get to that total of $53,000. We're going to take the $44,650, we're going to divide it by the total compensation of $265,000, and that's going to give us a percentage of 16.8% of pay. Now again, each participant has to receive the same percentage for their base allocation, so then we're just taking that 16.8%, calculating that right down the line. The only other person who has excess comp is going to be the second owner. All of the other employees don't have any excess comp, so it's just that straight 16.8 times their annual compensation, and that's going to yield their total allocation. So here we see, again, the owners maximized at $53,000 each, but now the total cost to the company has dropped to $159,760. As we shift gears away from those design-based allocation methods, again, the per capita, the pro rata, and the permitted disparity, we're shifting to new comparability, and really what that does, as does the age-weighted method that we're not going to spend a whole lot of time on here, but those take advantage of the time value of money. And kind of very straightforward illustration here on the screen, but essentially if we have two employees, one age 30 and one age 55, and we're targeting equivalent benefits at retirement age, so right here, and we've got a assumed retirement age of 65, we're going to have to give the 55-year-old individual $10,000 a year in order to reach $100,000 in age 65, because we only have 10 years to get there. Whereas with the 30-year-old employee, we've got 35 years to reach the targeted benefit, so we can provide a smaller allocation of $2,875 a year to still reach that equivalent benefit of $100,000 at retirement age. Now, there's a lot more that goes into it. The testing that we have to do takes a look at we have interest rate assumptions, we have discount rate assumptions, so that there are a number of different factors that go into this future value, present value calculation. But at the end of the day, really what we're doing is what you see on the screen, and taking advantage of the relative distance to retirement age in order to fund larger contributions for certain individuals. So moving on to the new comparability method, really what it does is it allows you to divide the participants into groups and then allocate different levels of contribution to each group. So how do we determine the groups? Well, one option is to use what are referred to as valid business classifications. So this might be owners versus non-owners. In a law firm, it might be partners and associates and staff. In a medical practice, it might be physicians, nurses, and staff. Really any number of characteristics can be used as long as they're valid business classifications. You typically can't use age. You typically wouldn't use something like blonde hair or blue eyes or something like that, except maybe if your business was a modeling agency, then perhaps that would be a valid business classification. But really what we've seen over time is, rather than trying to figure out how to classify individuals, is for the plan to say that each individual participant is in his or her own allocation group. And really that provides the maximum flexibility, because the company can decide on a person-by-person basis how much of a contribution each person receives. Now, we do have to define the groups in the plan document. If we have each person in their own group, that becomes pretty easy. We just say each participant is his or her own group. If we do want to try to define things, we have to be careful how we define them. So, for example, if we want to say owners and non-owners, we have to think about the fact that certain family members are attributed ownership. So if a wife owns 100% of the company and her husband also works for the company, the husband will be attributed the wife's ownership. So they'll both be considered 100% owners. So in our grouping, do we mean direct owners and attributed owners, or just direct owners? So that's what I mean when we say we have to be careful with definitions. So again, placing each participant in his or her own group alleviates a lot of those concerns and makes the documentation a lot more straightforward. Now, while there is flexibility in determining the contribution that each person receives, there are minimum contribution levels. And what we mean by that, or what I'm referring to, is the minimum gateway contribution that has to be provided to each non-highly compensated employee. And essentially that gateway contribution is going to be the lesser of 5% of that person's compensation, or 1/3 of the highest percent allocated to any highly compensated employee. So if all of your highly compensated employees receive 9% of pay, the gateway is going to be only 3%, or 1/3 of that 9. Going in the other direction, though, if we have highly compensated employees that are receiving 18%, our gateway is going to be capped at 5% of pay. We don't continue at that 1/3 ratio, so it doesn't go up to 6% from there. Now, one thing to keep in mind is that this gateway is just kind of your ticket in the door to use new comparability. It doesn't guarantee you're going to satisfy the additional non-discrimination tests. So this is sort of the threshold. Again, that's to allow you to use this method in the first place. We still have to run the non-discrimination testing, which may trigger a contribution higher than 5% or higher than that 1/3. And we'll see that in our next example. Okay, so here's our familiar looking contribution chart again. You can see that our owners are again maxed out at $53,000. That's still 20% of their pay. That hasn't changed. But what has changed is the amount that we have to give to each of the employees. So the gateway contribution here is going to be 5%. And that's going to be based off this 20%. So again, it's going to be the lesser of 5%, or 1/3 the amount allocated to the highly compensated employees. In this case, that's going to be 5% of pay. We don't have all the gory details on the test results here, but when we ran that 20% 5% combination through the required non-discrimination testing, we actually found that the test failed. And it required a contribution of 6.5% of pay to the employees in order to satisfy not only the gateway, but the additional non-discrimination testing that takes place. But even at 6.5%, you can see that the total outlay for the company has dropped considerably from our prior methods and is now only $122,800. More importantly, you can see right here that the owners are receiving 84% of that total contribution. When you start to take into account the tax implications as to what would happen if the owners kept this $122,800 in after-tax take-home pay rather than putting in the plan, they're both going to be giving up close to half of that in taxes. So if half of that goes to Uncle Sam and federal and state income taxes, they're left with basically $61,000 to split. So they're getting just over $30,000 each. So by putting it all into the plan, they're getting $53,000 each, and that's going to be 84% of the take-home. So assuming they don't need that money to live, to maintain their lifestyle and satisfy other financial obligations, putting the money into the plan is actually going to be more financially beneficial for the owners than if they were to take the money as cash and pay taxes on it. Okay, so let's take a look at all of our allocation methods side by side. Again, the goal across the board was to maximize the owners at $53,000. The per capita method is really easy to understand. Everybody gets the exact same dollar amount. But as you can see, not only does it not meet our goal of maximizing the owners, it's also the most expensive of all of the options that we have here. As we work our way across, you can see that the cost goes down, but you can see that the percentage that goes to the owners, even though it stays constant as a dollar amount, $53,000 all the way across, their percentage of the total goes from 62% to 84% of the total contribution. So at the end of the day, by going from per capita to new comparability, the owners are maximizing their benefit and they're saving $90,000 in their total contribution cost. Now, if you're talking about a really large company with millions and millions of dollars of annual revenue, saving $90,000 might not be that impressive. But this is certainly scalable. And when you're talking about smaller organizations, you're saving $90,000 in contributions. That's more than 10% of payroll. And so that becomes a pretty meaningful number. And again, the only thing we're doing is going from a very simple and straightforward method on the per capita option over to new comparability, which again is a little more complicated, a little more expensive to maintain, but in the grand scheme of things, maximizes the owners, minimizes the cost, and can work out very, very favorably in the right circumstances. Now, oftentimes what we see is a combination of the new comparability profit sharing allocation method with what's called a safe harbor 401k plan. And again, the safe harbor 401k is going to say that as long as the company agrees to put in a minimum of 3% of pay for all the employees, it gets a free pass on the 401k non-discrimination test and allows the owners to defer as much as they want to here. In this case, $24,000 and $18,000, with owner number 1 being over age 50. That's the reason that maximum is higher than for owner number 2. So if we do that, now we only need to, we've got the $79.50, which is the 3% of pay for the safe harbor. Now we only have to fund an additional $27,050 in order to maximize the owners. And again, there's our $53,000 magic number because our owner number 1 is over the age of 50. By adding on a 401k and allowing him or her to take advantage of catch-up contributions, that maximum goes up to $59,000. So again, by putting all of these principles together, again, we're able to maximize the owners. The total cost to the owners is going to be the $84,000 that we see here, plus the amounts that they deferred up here, the 24 and the 18. So the total cost to the owners is going to be $126,000. Or $126,016. So, and again, that provides a slightly larger benefit to owner number 1, through the catch-up deferrals. So again, this just illustrates how you can mix and match, taking the new comparability profit-sharing allocation method, layering that on top of a safe harbor 401k plan. One important thing to note is that this 3% safe harbor contribution that you see in this column right here, that does count towards satisfying the gateway contribution that we talked about previously. So instead of saying it's the 3% plus the gateway on top of that, the 3% counts towards satisfying that. So really what we're looking at is we've got the highly compensated employees are getting a 10.2% profit sharing contribution. They're getting a 3% safe harbor contribution for a total of 13.2. If we take 1/3 of that, then we're going to arrive at 4.38, which is the gateway that we have to give to all of the employees. Well, we're already giving them 3% down here as part of the safe harbor, so then all we have to do is give them an additional 1.38% under the new comparability profit sharing in order to satisfy our gateway requirement. And in this circumstance, providing the employees the gateway only contribution does satisfy the non-discrimination testing, so there's no additional contributions that are required over and above that. Okay, so there are some rules in place on how to change methods. So if a plan is written one way and the company wants to move to one of these other allocation methods, it is going to require a formal amendment to the plan document to specify which method is going to be used. And the change has to occur before the first participant accrues a right to a contribution for the year. And this IRS technical advice memo that we have referenced down here at the bottom explains that, but essentially once somebody earns the right to share in the contribution, then the allocation method is stuck for that year and can't be changed until the next year. So if the plan has got a requirement that says you have to be employed on the last day of the year to get a contribution, then the company has all the way up until December 31st of that year to make a change to a different allocation method. There are some plans that'll say, rather than a last day rule, that a participant has to complete a year of service, which is typically defined as 1,000 hours during the year. For a full-time employee, that works out to be approximately May 21st. So once the first person hits 1,000 hours for that year, you're stuck with that allocation method and you can't change it until the following year. If a plan has no last day rule and no hours requirement, then really on January 1st, the employees have earned a right to share in the contribution for that year, and that means that no change can be made to the allocation method until the following year. So again, we've got to look at the specifics of the plan to determine when a change can be made, but no matter when that happens, it does have to be done through a formal amendment to the plan that is signed by the plan sponsor. So again, relatively straightforward process. It's really just a matter of being mindful of the timing to ensure that it happens at the right time. Okay, now we're going to shift gears a little bit. So rather than talking about how we divvy up the contribution among the employees that are eligible for the plan, we're going to talk a little bit about what we can do to exclude certain employees so that they are removed from the calculation altogether. So the test that we look at when determining how many employees we can exclude is called the ratio percentage test. And unlike what we talked about with new comparability, where we're testing the amounts of the contributions that are given to each person, the ratio percentage test is really a head count. So it's really just looking at how many people are getting a contribution rather than how much of a contribution they're receiving. And basically, the way it works is that the plan has to cover at least 70% of the non-highly compensated employees, or 70% of their ratio percentage. And the best way to talk through that is to show a quick example. So if we've got a plan that has 4 HCEs and 10 HCEs, and the plan only covers 2 of the HCEs, or 2 out of the 4, that means the HCE ratio, coverage ratio, is 50%, or 2 out of 4. So in order to determine how many non-Highleys have to receive a contribution in the plan, we're taking 70%, which is the magic number from up here, we're applying it to the 50%, which is the HCE coverage ratio, and we see that we have to cover at least 35% of the plan's non-highly compensated employees. So in this circumstance, we're just taking the 35 times the 10 non-Highleys that we have. We get 3.5. You can't cover half a person, so we round up. The plan has to cover 4 non-highly compensated employees, which means it can, in turn, exclude the other 6 and still pass the ratio percentage test. So this can be a very effective way, again, to control the costs of making a profit sharing contribution by only providing it to the minimum number of people that are required. Now, just like we talked about with defining groups for the new comparability allocation method, when you're writing into your plan document who you want to exclude from the plan, you've got to be very careful in terms of how those definitions are written. For starters, again, these exclusions can be based on valid job classification, so a concept that we talked about before. So you can see some of the examples. It's going to be title or job function, a location or a division. So everybody in the Minneapolis office is in, anyone in the St. Paul office is excluded, just as an example. Hourly versus salaried employees. What is not permitted is to exclude folks on a categorization that's indirectly based on service. So, for example, seasonal employees. That's indirectly based on the length of their service and the fact that they're only there for part of the year rather than the entire year. And what the IRS says is that using those sorts of exclusions is you're really making an end run around the statutory eligibility requirements that says you can't keep anybody out generally any longer than attainment of age 21 and completion of 1 year of service. So if it's indirectly based on service, you can't use it to exclude people. If it's based on a valid business classification, then you can. Again, of course, subject to satisfying that ratio percentage test. Okay, so let's look at a couple of specific examples. So let's just say that we're dealing with a country club, and they want to exclude their seasonal workers. Well, like we talked about on the last slide, you can't really do that because the IRS says, again, you're indirectly violating the statute by excluding people based on the amount of time that they work. But if those seasonal workers happen to be groundskeepers and concessionaires, then you could exclude just that, groundskeepers and concessionaires. So you're getting to the same end result, but you're excluding people based on their job classification or their job title rather than the amount of time they work as if you use seasonal workers. So again, two different routes to the same place. The groundskeepers and concessionaires is permitted. Excluding them based on their classification as seasonal would not be permitted. Where you get into the importance of being detailed is in some of the other classifications. So for example, some plans will say we want to exclude students from being covered under the plan. Well, what do you mean by student? Do you mean interns? What about full-time folks versus part-time folks? Let's just say there's a group of employees that are working full-time during the day and they're taking classes at night. Is the intention to exclude them? Or is it just to exclude those that are full-time students and only work for a couple of hours here and there? What happens if the CFO of the company decides to go back and get an MBA and is enrolled full-time? Is the intention to exclude the CFO of the company in that circumstance? Probably not. So the key here is to make sure that when writing into the plan document who you want to exclude, you want to be very, very specific. Okay, so let's take a look at our fictitious law firm, Slip-a-Fall and Sue LLP. Their demographics are on your screen. So we have 30 partners, half of whom are going to be highly compensated based on ownership. So they're all going to own 5% or more of the law firm. They're all going to be highly compensated based on their pay, so they all earn more than $120,000 a year. 15 associates, 10 who are HCE based on comp, 5 who are non-highly. 60 staff. The firm administrator is going to be highly compensated based on compensation, and 59 of those employees are going to be non-highly compensated. So one option here is to exclude associates. That's a fairly common design in law firm plans. So if we were to do that and just kind of work our numbers right down the line, we've got a total of 41 HCEs, including the partners and some of the associates. Only 31 of those are going to be covered by the plan because 10 of them are associates, so that gives us a highly compensated coverage ratio of 75.61%. Again, 70% is our magic number, so we multiply that by the HCE coverage ratio, and the plan has to cover 52.93% of the non-highly compensated employees. Again, carrying forward the simple math, we have 64 non-highlies in total. Multiplying by our 52.93 means that we have to cover 33.88 non-highlies, rounding up 34, which means the plan can exclude a total of 30 non-highly compensated employees. So again, that can be a pretty compelling design. Right off the top, the law firm can exclude 30 non-highlies when allocating its profit-sharing contribution. Certainly that's enough to cover all of the associates, and then 20 of the staff members as well, to the extent the firm wants to do that. It could be a significant way to save some benefit dollars. But we also have to keep in mind that there might be some other options that are better. So, for example, a lot of times the associates are usually going to be younger than the partners are. And like we talked about with the new comparability method earlier in the session, taking advantage of the time value of money, it might make sense to keep the associates in the plan and give them a 0% contribution. Because then you have a group of highly compensated employees getting no contribution, and that's going to really reduce the average benefit that they're receiving, which is going to help the overall results for the non-discrimination test. Another thing to think about, depending on the demographics, and this is always something you kind of want to work through the calculations to figure out if it makes sense, but that is to add what's called the top paid group election, which limits the number of highly compensated employees to only the top 20% ranked by compensation. So if this plan adds the top paid group election, we're going to limit it to only 21 highly compensated employees. So now we have 9 partners and 15 associates who drop out of the HCE range into the NHCE range. So depending on how the plan is designed, how much those individuals are deferring into a 401k, how much of a profit sharing contribution is being given, moving those 9 partners and 15 associates to the non-highly compensated group can actually serve to boost the average benefit that the non-highly compensated group is receiving and can actually help the test results be more favorable. So kind of the point in showing you all of these different things is that there are a number of different ways to design the profit sharing plan to maximize the benefits, to provide broad-based benefits, whatever the goal is, and it's really a matter of understanding what the goals are and then working through the calculations to determine what's going to be the best fit in a given circumstance. And that concludes the session. If you have any questions, please feel free to post those on the message board and discuss from there. Thank you very much.